The US Congressional Budget Office has raised its outlook for the US deficit over the coming years, now seeing the figure averaging 6.1% of GDP over the next decade. Tax cuts introduced in President Trump's budget bill last year are forecast to increase deficits by $4.7 trillion across the period, outweighing a revenue increase from the administration's tariff policy. Joining us now, Tom Hulick, CEO at Strategy Asset Managers. Tom, does that warning from the Federal Budget Office affect your outlook for the US this coming year?
Oh, good morning. No, it actually doesn't. I mean, we're pretty optimistic about where the markets are going to be heading, not only in the U.S., but abroad. We're actually increasing our exposure into international equities and emerging markets right now.
And then in terms of the jobs report that we've seen, you could cut the cake in a couple of different ways. You could say the figure came in very, very positive for January, or you could focus in on the downward revision for last year. Which do you think is the dominant story out of the two?
Well, you know, we take a look at headline signals for the data that comes out, and you know, fortunately, this one was more on the optimistic side. You know, with the roughly double-digit expectations that were there, and the unemployment rate maintaining at about 4.3%. We take a look at where the jobs were actually created, and you looked at the healthcare sector, the construction sector, manufacturing. This is positive for a rotation of what we're seeing outside of the Mag 7 stocks and into a broadening of the market. So we look at the signals for this, and we think it's positive.
Tom, I'm fascinated by your rotation strategy. We've got some fresh records here in Europe, but that covers up the fact we've had a large cratering in some areas of the market, software names as well, similar to what's happened in the United States, others on the back of earnings. It hasn't been completely immune to some of those ructions. How careful are you about that tactical play here in Europe because of what I'm talking about?
Well, I was watching the show earlier, and you know, we take it very seriously. We look where the money is kind of flowing, and we're very positive about the business cycle remaining intact. But when you look at the you know, where the smart money is going right now, we underweighted tech for our separately managed account portfolios last year. We benefited from that, and we focused on the manufacturing sector. We also looked at the infrastructure add-ons and specifically energy. But we do think that there, you know, will be softening in certain areas, and it's you've got to know where to invest right now and where to not invest.
Point, Tom. You know, that whole conversation, yesterday's winners are not going to be tomorrow's winners. But if you look at yesterday's winners as in 2025, here in Europe, it was European banks. Across, when you look at Asia, it was the South Korean market, it was the Japanese stock market. And a lot of people are saying, be careful, particularly, say, around the South Korean market, up 75% last year, the winner globally. But this market continues to race ahead, as do the other names I've mentioned. The trades from yesterday, from 2025, aren't they the same trades for 2026?
I think there could be a continuation of it into 2026. We're definitely more positive for 2026 and even beyond. But when you see something that happened in Japan and the political mandate and this kind of industrial revival that's going on, you really are seeing this potentially even with inside of Europe. There's fiscal stimulus going on in Germany, Japan, across Europe, the United States. There's corporate reform. There are certain industries that are participating. One of the most important things that you want to look for is the banking industry. If the banking industry participates or the financials participate, it looks like we're going to continue on in that direction of being more positive.
Hey, Tom, nice to see you, and thanks for joining us so late in California. I understand the rotation, the diversification, the anything but tech story to a certain degree, but are the tech stocks actually that expensive now? I think in the private markets you could make a very good case for the euphoria still being there. But when I look at Nvidia, which still has a pretty dominant position, I see 23 times forward. I don't see something that's extraordinarily expensive. Is there a case for actually getting back into some of these techs?
We own all the mega caps that you were just talking about. NVIDIA in particular is one of the strongest positions that we own. We're not going to pull back from any of those positions because they're going to continue to be the leaders for probably the next decade. But it's really important to just to focus on what's really happening with the market. And as it broadens out, that's very, very healthy for an expansion, not only with the business cycle that we're in, but also going over into Europe and broadening out in the global markets. So, it's a very positive time to be investing in technology when it's leading the creation of a new era of manufacturing, industrialization, and we're going to witness it in the next 10 years.
And that's the listed market we're talking about. What about what we're seeing in the private markets? Because I'm seeing no pullback at all in some of the valuations. If anything, we've got an OpenAI $100 billion funding round upon us, we believe, as well. If anything, the prices look even more euphoric as well. Tom, should we be very circumspect, A, about the private sector, and B, what it means for the public sector?
Well, we invest in public companies. We have a couple of private equity funds that we have at our company. It depends on what sector you're investing in. For an overvalued position, you're going to eventually get to see something get marked to market. And in a position that we're in today, I do think that there's an opportunity to invest in the private sector and have outperformance over the public markets. But that's just my personal opinion there. I'm going to hold by it.
Tom, I've seen so many canaries in the coal mines. Like in my long old career, you've been around as long as me, I'm sure, Tom. The fact of the matter is, very often the canary in the coal mine does come from those corporate bond markets, does come from the private market, and it will have that ripple effect. You're not worried about that?
I'm not. I think you just have to look at what the outlook is for global investment. And in general, when you see government investing in fiscal stimulus continuing on, that sends a signal that there could be an additional additive to a growth in, let's just say, infrastructure. We all know that we have an aging infrastructure. We all know that we need to concentrate on building a better grid. Power is insatiable at this point. So I think that when you take a look at, what the opportunity is out there, whether it's private or public sector investing, there's still a need for it, and we can really accelerate in this area in 2026 and in beyond. We're very optimistic for a long-term business cycle in a bull market.
Great. Tom, can't believe it's 1:43 a.m. in Pasadena. You're a star. Thank you very much indeed for joining us all. Don't know how you do it. I couldn't even sleep properly at 1:43, let alone speak. Thanks, Tom. Tom Hulick, who is the CEO of Strategy Asset Managers.